Namaste, good morning. Welcome to session 2. The first part of the session, we should be able to complete transfer pricing and then move towards non-resident taxation in the fag end of the session. Hopefully, that is the plan with which I start the classes today. In the non-resident taxation arena, yesterday we were looking at transfer pricing, and we said that the travel is going to be as the section progresses. So we saw section 92 base rule, 92A, who is an associated enterprise, first broadly, then narrowing down. 92B, what is an international transaction? What is a transaction? What is an international transaction? 92B subsection 2 deemed international transaction. We kept aside domestic transfer pricing to be understood just as a theory at the end. And then we traveled at length in 92C, that is the various ways of determining arm's length price, the various ways of determining the arm's length price. We did some questions on that as well, on the methodology, and also after understanding the 5 methods: comparable, uncontrolled price method, resale price method, cost plus method, profit split method, transaction net margin method. Okay, after understanding these methods, we also understood what if there are multiple ALPs available. If it is less than 6, how? 6 plus how? How to do the range concept? What is the tolerance limit? Our travel was up to that yesterday. So 92C, the first part of it was covered well. Then comes 92C and CD. 92C and CD, which is talking about what is popularly known as advanced pricing arrangements. Section 92C and CD are the two sections which speaks about advanced pricing agreements, APA. Okay, I told you we will progress as the class goes, as the sections goes. Okay, so though I have given it as a separate unit, we have hit at a point where we need to understand that. So I'm almost in your page number 25 or 26, which consists of the small theory, the condensed theory of APA, Advanced Pricing Agreements. Friends, the voice I believe is clear and the video I believe is clear. Why I am checking whether the voice is clear is, as I told you, I have traveled outside Chennai to a small village and the fan is available. So I hope it is not a disturbance and my voice is clear to you. Can anyone confirm that aspect alone?
They're in between voices sometimes breaking.
Voice is breaking, that is different because that is network issue. Voice is having a noise, that is the fan noise disturbs, that is different.
No, background noise is not there.
Yeah, okay, thank you. Thank you. Regarding the breaking of voice, let me try to go slow so that even if there is, and I'll repeat it once more so that even if you have not taken it in the first time and the second time, you will be able to understand. APA is an agreement between the taxpayer and the government or the department. Government is nothing but represented by the CBDT. APA is an agreement between the taxpayer and the department. The APA can have two things or three things. First thing the APA can look into is whether the method adopted can be agreed upon. There are 5 methods. Which method is applicable to me? I and the government can enter into an agreement saying this is the method that the assessee need to follow. Second, it can tell the ALP itself, apart from the method, along with the method, they can determine the price itself, arm's length price itself. Everything is mutually exclusive. Not that I should do both. Just the method can be an ALP. Method plus ALP, the price itself can be an APA. Our transfer pricing or internationally transfer pricing is an evolving mechanism. Slowly it is evolving. Are you understanding? Slowly this transfer pricing mechanism is internationally getting popular. So probably some terms, terminologies are not yet clear. Some terms and terminologies are not yet clear. So that can also be forming part of an agreement. That can also be forming part of an agreement. So the agreement can be for, shall I repeat? The agreement can be for the method of determining ALP, ALP itself, terms and terminologies. Give me the definition of this particular term. Give me the idea of this particular term. These can also be part of the agreement. This apart, though it is still at the beginning stage, for determining, please understand, for determining the income that is taxable in India under Section 9. Because an income accrues and arises through a variety of transaction, through a relay of transaction, okay, to a continuous process of transaction which occurs at various regions across the world. I am repeating, a transaction or the entire aspect of a transaction is happening in a discrete manner across various regions of the world, in which one of the part of the transaction is also done by an Indian entity. So, how to determine or how to apportion the income to the Indian entity under Section 9? Income accruing or arising from India or deemed to accrue or arise from India, that can also nowadays become an APA. An assessee can enter, can tap the doors of CBDT saying, can we enter into an agreement to understand? To understand what? To understand what is that portion of income that is taxable in India in this particular transaction which is happening across the globe. So APA is becoming more popular for one other reason. It avoids future litigation. It avoids litigation. Once an APA is entered into, both the government and the assessee are supposed to, are bound by that APA. So in that manner also, APA becomes important. Let us understand APA from the examination perspective, what can be the questions, etc. And also look into one of the questions which appeared in an examination a couple of years back. This is an agreement between the taxpayer and the tax administrator. Okay, the taxpayer and CBDT. For us, it is CBDT for determining the method of computing ALP or the ALP itself. Once more, the slash is and or. You can put any term there. For determining the method of computing ALP or the ALP itself. And APA can be entered anytime. Application will be always presented at the beginning of the year. This is to avoid tax disputes. This is to avoid tax disputes, and the rules are framed under section 10F to 10T about APA. Okay. The rules itself are very interesting. The rules by itself are very interesting. Okay. The first process is not an application, my dear friends. Normally in other places which you are going to see, normally in other places which you are going to see, the first process is presenting an application for entering into agreement. Normally we are going to see that. But here it is very interesting. The first process is not even application. The first process is popularly known as pre-filing consultation. The first process is known as, before filing an application, I'm going to consult the tax department. Boss, can I file it? Let me be very clear. Just because you had a pre-filing consultation, there is no need that you should present an application. You can stop with pre-filing application. The law gives you such benefit. I went for a consultation with the department. I am not convinced with their answers. Let me go through the normal channel of assessment itself. Accepted. So, pre-filing consultation is one of the biggest benefit available for those who want to enter into an advanced pricing agreement. What is the pre-filing consultation? Go and speak to the department. Boss, I'm so and so. My case is this. I wish to enter into an APA. Can we discuss on what manner you will accept this APA? In what manner will you suggest my ALP, etc.? Okay. An application will be presented by the assessee to the department for pre-filing consultation. Just the consultation, that's all. Just a consultation, that's all. Assessee shall present all facts which on which he is entered into and seek consultation. Assessee shall also specify the TP method and the variation associated. Assessee shall seek definition for certain terms. I told you that there are three aspects in APA. Method of determining ALP, ALP by itself, and if there are some terms which are not very clear, definition of those terms can also be sought for from the department. Definitions of those terms can also be sought for from the department. So, you present an application to the department saying, I need some consultation. Remember, after consultation, I have not written that, but I wish that the class remembers this. After consultation, you can drop off. Not necessarily you should go to the step 2 of presenting an application for APA. You can just say, okay, I'm not happy with the consultation provided. I'm not happy. This APA is not going to be beneficial for me. So I would like to withdraw and go by the normal route. That option is available to you. That option is available to you. Suppose the consultation becomes favorable. Suppose the consultation has given the required clarity. Then the next step is entering into APA or presenting an application form. So this is where for entering into APA, you are presenting an application. Step 1 is just the consultation. Step 2 is application for entering into APA. Assessee shall apply for entering into APA with the department. Department, after going through all aspects specified by the assessee, shall enter into the APA. Application should be made in the specified form and the requisite fees has to be paid. Application has to be made in the specified form, paying a particular fee. What are all the contents of the APA? The agreement that is entered into between the department and the assessee. What is going to be the facts? What are all the content? What is the nature of international transaction? The agreed method of determining ALP. Okay, so if they agree on a method, the method of determining ALP determined, and definition of various terms. So the content of the APA shall be the nature of international transaction that the assessee is entering into, the agreed method of determining the ALP, actual ALP which is determined, which can also be there, and if you have sought explanation for certain terms, the explanation or the definition of those terms. Friends, in APA, in the future I will use it, okay, in APA, they are using a main terminology called critical assumption. They are using a main terminology in APA rules and in APA. They are using a main terminology called critical assumption. In determining the ALP, I asked you to remember a phrase. For analysis, FAR, for analysis. For analysis means functions performed, assets deployed, risk assumed. For analysis means functions performed, assets deployed, risk assumed. That is known as FAR, for analysis. If there is a question on APA, try to use this particular phrase called critical assumption. Because assessee presents the application saying that I am entering into an international transaction and these are all the facts of the transaction. The department relies on that. The department relies on the facts presented. Based upon these facts, they are giving that they are entering into an APA. Once more, assessee is giving a certain number of points, saying these are all the aspects on which I am entering into international transaction. The department believes. So I critically assume that whatever facts presented by the assessee is correct. Tomorrow, if this critical assumption changes, tomorrow, if this critical assumption fails, tomorrow, if the critical assumption is proved wrong, then the APA stands cancelled. If the critical assumptions fails, that is, assessee is unable to do the business the same way in which he presented. If the critical assumption is proved wrong, or if the critical assumption is not adhered to, in all these cases, the APA will be cancelled. So, if there is a question, theoretical question on APA, try to incorporate this word called critical assumption. That will earn us, that will tell the examiner that you have studied and understood this provision, provided the examiner also knows what is, once an APA is entered into, what is the binding nature of APA. What is the binding nature of APA? 1 minute, if we have any doubts, I will clarify. What is the binding nature of APA? This is a popular question. What is the binding nature? Okay, if I enter into an APA, not only here, when we are completing the international taxation, we will study about something known as advanced ruling. Okay, that is also having the same binding nature and same principles. What is that? APA is valid for the assessee as well as the department on the question it sought for. APA is binding on the assessee as well as the department. Though later I will come to this, but first I want you to highlight or understand this point called APA is binding on the assessee who has sought for it. APA is binding on the assessee who has sought for it. Imagine a circumstances. A Limited A company obtained APA. A Limited, a company obtained APA. A Limited amalgamated with B Limited. A Limited amalgamated with B Limited. Can B Limited use that APA? Means the answer is no. The answer is no. APA is valid only for the assessee who has sought for it, not for others. Even though amalgamation, demerger, whatever it is, okay, APA is valid for the assessee as well as the department. APA will be valid for such number of years. It cannot exceed 5 years. It cannot exceed 5 years. Okay. APA will be valid for such number of years and the maximum validity is only 5 years. And APA will not be valid. It will not be valid when there is change of law or change in the factors presented upon. This is what I call it as critical assumption. This is what the law uses the terminology critical assumption. Okay, when there is a change in the critical assumptions, when there is a change in the facts, I got the APA on the basis of some facts. When there is a change in the critical assumptions, then the APA will not be valid. So it is on the, if there is a failure, if there is a change in law or change in critical assumption. This is APA getting cancelled. APA cancellation is different from void. Repeat with me. Cancellation is different from void. Cancellation means so far it is valid, henceforth not valid. Cancellation means so far it is valid, henceforth not valid. Void means from the beginning it is not valid. Okay? Change in facts. So far the facts are correct. Change in law. So far the law is correct. From tomorrow it is different. Void. I got the APA itself by telling something which is not true. I entered into the APA itself by misrepresentation of facts. I entered into the APA by misrepresentation of facts or incorrect information. Then APA shall be declared void ab initio. Are you understanding? I entered into by misrepresenting the facts, incorrect information. In law, in the general law, there is a terminology called mens rea, culpable state of mind. I misrepresented the facts and entered into by providing incorrect information. APA will be void ab initio, from the beginning. APA will be void ab initio. Are we clear? Okay. So let me quickly say that there is a pre-consultation mechanism. After that, they enter into APA, okay, by presenting the contents. And the APA once entered into is binding on the assessee who sought for it and the department, unless there is change in law or change in critical circumstances. APA will be void if there is a mens rea, if there is a culpable state of mind. We started with one terminology called APA can be entered into any time. Application will be presented at the beginning of the year. This led us to believe that APA is always prospective and not retrospective. Repeat with me. APA is prospective and not retrospective. Then came and I told you transfer pricing is international. Everything is English terminologies only. Okay. Then came a provision called rollback mechanism. Then came a provision called rollback mechanism. Roll forward, prospective. Roll back. Can I use the APA for the past years? The department felt it saves time. So why should not I allow the assessee to use it for the past years? Once more, the department felt it saves time, no? Otherwise, assessment, appeal, first level appeal, second level appeal, third level appeal. Why all this cumbersome process? It saves time if I ask him to apply for the past years also. So, rules are framed for making the APA applicable for the past years also. How many years? We always know APA is for 5 years. So it can only roll back for past 4 years. It can only roll back for past 4 years. Let me go slow, then we will read the theory. First listen once, then we will read once, direct to examination. How to apply for rollback? Go and tell your commissioner, boss, stop my assessment. I have entered into an APA and I want to use it for my past years also. So an assessment is pending and I go and approach my commissioner or my principal commissioner saying, boss, wait, I have entered into an APA, I want to roll back. Go back to CBDT and request, can I use it for past years? Now, CBDT will evaluate, please understand, CBDT will evaluate whether the critical assumptions are the same. CBDT will evaluate whether the critical assumptions are same for past years also. So again the word critical assumption gets important. If the critical assumptions are same, please roll back. If the critical assumptions are same, then the loss is go ahead, roll back. If the critical assumptions are not the same, or I go back to the parent rule of transfer pricing. Yesterday we started with this, where transfer pricing application results in reduction of AVLP, the assessment process will be dropped. If the rollback mechanism results in reduction of income, such rollback will not be allowed. Such rollback will not be allowed. Okay? Okay? Let's understand rollback mechanism. Let's understand rollback mechanism. Where APA has been entered into, can it be made applicable for past years? For that, assessee should make an application for APA validation for past years. The board, CBDT, should be convinced that the international transactions of the past years are also of the same nature and the critical assumptions are also the same. On what basis now I gave? It is the same thing which is prevailing in the past also. If the board is convinced, then they shall provide for rollback mechanism as a part of the agreement itself. Okay, right, you can roll back. Maximum can be 4 preceding years. Maximum can be 4 preceding years. I want you to understand something. That's why I stopped here, though it is not. Should I opt for all 4 years or can I pick and choose? First year, third year. The law says you are not having that option. One of the circulars says FAQ has been released by the CBDT. It is not there in the main law, in the act it is not there, but in the FAQ that they released, they have said the assessee does not have the option of choosing years. The assessee does not have the option of choosing years. So he has to necessarily go back for 4 years. Rollback is applicable only if return is filed within the due date mentioned in 139(1). Remember, if you have filed a belated return for that year, you cannot roll back. If you have filed a belated return, you cannot roll back. Assessee should have got the 92E, the honest person certifying, that is nothing but chartered accountant. Don't laugh, I'm just saying. Assessee entering into APA, very important, should file a modified return. Friends, you all know about original return, revised return, belated return, defective return, loss return. There is something known as modified return. What is modified return? Where a APA has been entered into. Repeat, where a APA has been entered into. And I want to give effect to the past years. Then the past year returns has to be modified. Now I went and presented to CBDT. Sir, please consider. The CBDT said, okay, go ahead, roll back. Even though time has lapsed for those things to file a belated or a revised return, I can file what is popularly known as a modified return. Modified return should be filed within 3 months from the date of entering into agreement. For all those years for which assessee has filed modified return, AO shall complete the assessment within 12 months from the end of the month of APA. So within 3 months I will file, within 9 months he will complete. Assessee at the time of filing the modified return itself pay the taxes. When will APA rollback mechanism not given effect to? When it will not given effect to? If it is not at assessment level, but it is at appellate level. Assessment is over and it has gone on an appeal. If the stage of completion is not assessment but appeal, one benefit is there. They can withdraw the appeal and file. I will come to that. If by applying APA, the income compute reduces, then APA will not be applicable. Transfer pricing goes by one mechanism. It can only be revenue friendly. It cannot be assessee friendly. What happens to appeal filed but judgment not yet rendered? the person who filed, be it assessee or department, can withdraw the appeal and apply for modified. In case of merger of companies, the agreement is between the board and the specified assessee. Only that assessee can roll back and not applicable for other merged entities. 2 minutes for you to read. DIY, this is a November 19 question. Okay. Question number 33 in our material should be in 41 or 42. DIY Limited, a company registered in India and subsidiary of CD Incorporation, a company registered in Austria. DIY Limited engaged in the manufacture of fabric. To arrive at the ALP applicable to its transaction, enters into an APA with the board on 25th November 2020. Accordingly, there will be suitable substantial changes in the income. Also, DIY Limited wishes to apply for rollback for 1617, 1718, 1819 and 1920. The AO wants to apply such transfer pricing provisions from the year in which DY Limited became the subsidiary, that is assessment year 1415. Okay, that is sorry for taking 1 minute away. Okay, we always think, no, that the AO is a fool and only we are brilliant, okay? All our questions should be designed like that. We all know 4 years only you can roll back, okay? Look at the question can even be DIY want to roll back from 14-15 and ask us to answer, we would have answered. DIY is correctly rolling back 16-17, 17-18, 18-19, 19-20. But the AO wants to. Always our questioning of our institute is AO should be wrong. Always our questionings in FR and accounting standard is the accountant of the company want to do it. Because only chart accountant should be right. Okay, sorry. Okay, right. So you understand here, this is AO's contention. DIY Limited had filed its return of income for 2021 on 26th August and 31st August. The assessment years are completed, but the assessment is pending on the date of entering into AP. You are required to answer the following. Whether the AO is correct, the AO is not correct. You cannot roll back beyond 4 years. Now 14-15 is beyond the period of 4 years. So you cannot roll back. Second, in respect of 18-19, the TP arrived at by the board is resulting in reduction of income. Discuss whether the rollback can be applicable. No, rollback is not applicable if the critical assumptions are not the same, if the transactions is not of the same nature, and it results assessee friendly, which means there cannot be a reduction. What will happen to all completed assessment? That will not be touched upon. That will not be touched upon. Since it is a theory question, give me the benefit of taking the answers directly. No, the assessing officer is not correct in applying the TP provisions for 14-15 itself. This is so since rollback provisions can be applied only for any previous year falling within the 4 years. Okay, since 2021 is the first time, the 5 consecutive years is only from 17-18 and not from 14-15. So the first answer is it goes beyond the 4th year, so you cannot. Second, no, the rollback cannot be applied in respect of a transaction if the application has the effect of reducing the total income or increasing the loss, as the case may be, as declared. So you cannot do that. Okay, so for 18-19, DYA has to furnish modified return in respect of assessment year relevant to the previous year for which APA applies within a period of 3 months from the end in which the agreement was entered into. The modification should arise only because of APA. Such a return would be treated as a filed return under 139. In case of completed assessment, the AO would assess or reassess or recompute the total income. Having regard to the APA, such order of assessment has to be passed within 1 year from the end of the financial year in which modified return. This was the old law, now it is 9 months only. Everything started slashing down by 3 months. This was when the question came in, it was like this. Okay. So, if the completed assessments, the crux of this issue is, if the completed assessment is within that 4 years, I told you assessee cannot choose. Assessee cannot choose. All the 4 years the AO will open and close it. So if it is within 4 years, fine. If it is beyond 4 years and the assessment is completed, anyhow APA cannot be applied, anyhow it cannot be done. This is a 16-mark question. I mean it, it is 12-mark question. It's a 12-mark question that came into one's with regard to APA. Now it can also be uh, a MCQ pattern question on APA because there is enough scope. Okay, now coming back to our discussion. APA over, I will tell you in law words itself, section 92CC overrules 92C. Repeat with me. Section 92CC overrules 92C. Why I am saying this? I have entered into an APA. I have arrived at the ALP. By applying 92C, I am getting one other ALP or getting more than 5 ALPs or getting, once APA is entered into, it is binding on the assessee as well as the department. There is no question of going back on that. So 92C can give you a different pricing also, but that will not stand. Only 92CC will stand. Only 92CC will stand. Okay, that is with regard to ALP. So we studied 92C, 92CC and CD. With that, I go into one other important questionable area, section 92CE, primary and secondary adjustment. One of the important questionable area in transfer pricing, primary and secondary adjustment. Let me take a minute of you to explain this, then go to. Primary adjustment is what happens in my book. Primary adjustment is what happens in my book. Okay, yesterday we worked out so many things. Okay, total increase, therefore income is increased by 92 lakhs. Okay, income can be enhanced, can only, since the income is enhanced, okay, you cannot, and there will be penalty. Okay, therefore income increases by 49,26,000. I, the Indian assessee, my income is understated or expenses is overstated. If it is import, expenses overstated. If it is sale, income is understated. All of us together. So the assessing officer makes the adjustment, or suo motu I make the adjustment to increase the income. To increase the income. Now please understand, what I have made an adjustment is only for the profits and not for the cash imbalance. Let me take this 92 lakhs as example for a minute. I imported goods from Chetan for 60 crores. I should have imported only for 50 crores 18 lakhs. For example, I am saying, I have imported for 60 lakhs, which is increased, so 59 crores 8 lakhs. 59 crores 8 lakhs only my import price should have been, but I have imported for 60 lakhs. 60 crores. Assessing officer has made the adjustment now. Now, when I imported, I passed the entry purchases account debit to whichever party, Bada Private Limited or something like that, 60 crores. I passed the entry and I paid that money also. Bank account, party's account, creditor's account, debit to bank. I passed the entry. Now the assessing officer says, I increased the income by 92 lakhs. Your import cannot be 59 crores, 8 lakhs. If your import cannot be 60 crores, it can only be 59 crore 8 lakhs. But I have paid money, boss. My forex is lost. Our country's foreign exchange is lost. So now the law says make the secondary adjustment. This is known as primary adjustment. In my books, in the books of the Indian entity, make the adjustment in the books of the associate enterprise also. Ask him to give back the money. Or if I have collected less for my sales, ask him to give. Secondary adjustment is done in the books of the associated enterprise. Secondary adjustment is done in the books of the associated enterprise, so that not only the profit mismatch is being managed, even the cash flow mismatch is being managed. Primary adjustment to a TP means determination in accordance with arm's length price, increase in total income in the books of the assessee. Secondary adjustment means books of the assessee and its associated enterprise to reflect the actual allocation of profit. Okay, removing the imbalance between the cash account and actual profit of the assets. Not only the money, physical flow of money should be there in case of secondary adjustment. This is again given by OECD. It's a norm by OECD. Now all of us understand. When should I do secondary adjustment? If the income, if the adjustment exceeds 1 crore. So in the given example, Shumma, I gave you an example that is 92 lakhs, you need not make. But generally, if the adjustment exceeds 1 crore, within what date the money has to be repatriated? What are all the consequences? Very important, questionable area also. Okay, let's go slow. Secondary adjustment is mandatorily to be made in the following circumstances. Where the primary adjustment is due to suo motu, Anush Motors. Yesterday we worked out a question where we said Toyota cars sold at a lesser price, 1% on the 100 crore loan, the 1000 crore loan I got. Suo motu, I myself make it. Made by the AO and that has been not contested by, accepted by the assessee. Remember? Adjustment is made by the assessing officer, which has been accepted by the assessee. If it is due to APA, if the difference is due to APA, as per safe harbor rules are not notified, forget it. Forget it, safe harbor rules are not there for your examination, forget it. Arising as a result of an agreement for avoidance of TTA. Once more, together shall we repeat? When should secondary adjustment be made? If the primary adjustment is due to suo motu or order by AO which has not been contested by the assessee, or due to APA entered upon, safe harbor rules which is not yet which is not yet notified, and is based upon DTAA between countries. OECD guidelines specify that secondary adjustment may take the form of, that is, the money can be received in the form of dividend, equity, or loans also, no problem. Not necessarily it should be income inflow, but inflow should happen to our country. Where the associated enterprise fails to repatriate. They are supposed to give the money. They are not giving me the money. Indian government is losing revenue. How do you say that the Indian government is losing revenue, sir? I understand Indian government is losing foreign exchange. Okay. How do you say, if you ask me a question, how do you say Indian government, income tax department is losing revenue? I have one answer to you, my dear friends. Had the money come back, I would have invested. Had the money come back, I would have invested and earned more profit. That's how the working capital cycle works, right? I have got a bank loan for 1 crore. Had this 92 lakhs come into India, had come into my bank account, why do I need that 1 crore of loan on which I am paying an interest? Or at least this 92 lakhs I would have deposited, invested and earned a return. So, opportunity lost is also considered as tax lost. Okay? Where the AE fails to repatriate the money on or before 90 days, then it will be treated as if I gave loan to my AE. Then it will be deemed as advance given to AE, and the AE is supposed to pay me interest, or I am supposed to accrue interest. Once more, shall we all tell the provision? Where AE fails to repatriate the money on or before 90 days, then it will be considered as if I have given loan to that AE and they are supposed to pay me interest, or I am supposed to accrue interest. Interest rate will be SBI rate plus 3.25% if it is Indian currency, or LIBOR plus 3% if it is foreign currency. No secondary adjustment, okay, if it is not exceeding 1 crore. Where the associated enterprise fails to repatriate on or before 90 days. Sir, 90 days of what, sir? 90 days of what? All of us. Within 90 days, I have to repatriate. If I fail to repatriate within 90 days, here, suo motu, 90 days from the due date of filing returns. Say again, 90 days from the date of filing return. Order of AO which is not contested, 90 days from the date of order. 90 days from the date of order. APA divided into 2. Please understand, APA divided into 2. APA entered before due date of filing returns. APA entered before due date of filing returns. 90 days from the due date of filing returns. 90 days from the due date of filing returns. APA entered after the due date of filing returns. 90 days from the end of the month of APA. APA 90 days, the APA entered before the due date of filing returns. 90 days from the due date of filing returns. APA entered after the due date of filing returns. 90 days from the end of the month of APA. In all these cases, the problem is if you don't get it within 90 days, interest is not computed from the 91st day. It is computed from the first day. Repeat, if money is not repatriated within 90 days, interest becomes computed. The law says it will be taken as loan and interest needs to be computed. From which date the interest needs to be computed? Interest needs to be computed not from the 91st day, but from the first day itself. Interest needs to be computed not from the 91st day, but from the 90 days from the due date of filing return, where he has not repatriated within 90 days. Then interest will be computed from the due date of filing returns. From the date of order, from the due date, from the date of entering into end of the month of APA. Okay, safe harbor rules are not yet notified. After all these things, one small benefit which the law gives me is option to pay additional income tax. I know you cannot repatriate. Do one thing. Once for all, the assessee has the option to pay 20.994. How I got it? 18% plus 12% surcharge plus 4% cess. You pay it. No more you need to charge interest. I will also not ask you any question. No further demand will be made. No further demand will be made. Please read through from the top once. Please read through. Okay. Okay. One of the important questionable area. Okay. And there in question number 20, I'm there in question number 20, should be page number 37 for you. Vishnu Polymers Limited is an Indian company having transactions which are subject to TP regulation. In June 18, the assessments of for AY 1920 and 2021 were concluded after the due process. In both the years, in respect of the transaction with its associated enterprise, the ALP has been determined in euros, foreign currency. For the assessment year 1920, the primary adjustment is translated into INR 90 lakhs for transaction with N Incorporation Singapore, and for assessment year 2021, the same being 2.4 crores for transaction with PK Incorporation, Melbourne. The assessment order was passed on 12/6/2020. It is actually June 2020. Okay. Old question, I took it as a question. The assessee is inclined to accept the same, not dispute it, and not prefer an appeal. You are required to answer the following. How will the quantum of primary adjustment be treated in the books of the assessee as well as secondary adjustment? How will the forced completed assessment impact the assessee? What steps are to be taken to prevent a secondary adjustment? Will there be any secondary adjustment in the hands of the assessee if the required steps are not taken? You are required to outline the concepts involved. I am writing the answer in TP theory question. This is not a practical question. This is a theory question. So I am writing it here. So the assessment was completed on 12/6/2020. I don't know how many of you noted. I will be very happy if you have noted. I will be very, very happy if you now note it so that you never do this mistake again. For 1 year, no secondary adjustment because it has not exceeded 1 crore. For the other year, that is for 1920, no secondary adjustment. Only for 2021, there is secondary adjustment. Okay? If you have noted, happy. If you have not noted, doubly happy because you gave me an opportunity to tell you so that henceforth you will not forget this. Okay? So, how will the quantum of primary adjustment and secondary adjustment be dealt with? Primary adjustment, that which takes place in the books of the assessee, in our case Vishnu Polymers. Okay, here our assessee is Vishnu Polymers. Okay, our assessee is Vishnu Polymers. So what takes place? Okay, primary adjustment shall be carried out by the AO for both years in the books of assessee. Okay, the AO will increase the income by 90 lakhs for the financial or assessment year 1920 and 2 crores 40 lakhs for assessment year 2021. There is no change in the primary adjustment. If the adjustment is due to underreporting or misreporting, then AO can initiate penalty proceedings under 270A. If you remember, write this point, it will value add to your answer. Okay, this is the state of primary adjustment. Secondary adjustment, that which is done in the books of AE so as to ensure that there is no cash imbalance. Secondary adjustment is one which is done in the books of the AE so that there is no cash imbalance. For financial year 18-19 or assessment year 19-20, for AY 19-20, secondary adjustment does not arise, okay, as the quantum of adjustment has not exceeded rupees 1 crore. So there is no reason for a secondary adjustment. If the quantum is not exceeding 1 crore, no problem. Okay. For AY 2021, okay, PK, the quantum exceeds rupees 1 crore. Okay. Adjustment. Somebody's mic is on. Vashi, can you show the mic is off? Okay. For assessment year 2021, the quantum of adjustment exceeds 1 crore. Adjustment needs to be made in PK incorporation. Vishnu Polymers is liable to, okay, Vishnu Polymer is liable to repatriate rupees 2.40 crores within 90 days of assessment order. The assessment order, I think, is 12th June. The assessment order is 12th June. Within 12th June is the assessment order. Within 90 days, they are supposed to get back the money. The question: how will the forced completed assessment impact the assessee? Now I am going to the next step. What steps are to be taken to prevent hazard? Okay, within 90 days. Will there be any secondary adjustment if required steps are not taken? Okay. Consequences if money is not repatriated within 90 days. What are all the consequences if the money is not repatriated within the said 90 days? Assessee, that is Vishnu Polymers, is liable to treat the money as advance and charge interest at LIBOR plus 3%, because the transaction is in foreign currency. Okay, transaction is in foreign currency. Okay, so it should be LIBOR plus 3%. Assessee is liable to treat the money as advance and charge interest at LIBOR plus 3%. Interest will be computed from the date of assessment order. Interest will be computed from 12th June till the year end 31st March 21. You will compute the interest and you will record it as income if money is not brought back. Will there be any secondary adjustment? Okay, if they required or not, you are required to outline the concept. Okay, finally I write way of avoiding secondary adjustment. The other alternative for Vishnu polymers is to pay additional tax. The other option, so I am unable to repatriate, and the law gives you one other option, pay additional tax. Additional tax will be 18% base tax plus 12% surcharge plus 4% HEC or rupees 2.40 crores. No complacency, please. Write the answers. Okay. By writing, you are becoming more sure about the answers. Okay. Wherever theory question which need not be repeated an answer of writing the same thing, we will refer to the solution book. But otherwise, the same effort we both have to put in. Okay. So please write the answers. Continue in question number 4. Sony Japan and answer the following. So this answer will not be there in the material, final addition by me, just to ensure once we are clear about all computation. We all did Sony Japan. The increase in income is due to application of ALP 6 crores. 6 crores. Okay. So in the same Excel sheet, in the same practical Excel sheet, I am continuing. Question number 21. In question number 4, the conclusion arrived at is income of the Indian entity has to be increased by has to be increased by 6 crores, my dear friends. By 6 crores. Okay, please give the reference as Sony Japan. The first question which we worked out in ALP, 6 crores. Now let us understand. Assume primary adjustment is made by assessee suo moto. Return filed on November 30th November is secondary adjustment mandatory. Part A, where adjustment is suo moto. The other things are on the basis of assessment order, which is not contested. APA, safe harbor rules, DTAA. Okay, where adjustment is suo moto and the quantum of adjustment exceeds rupees 1 crore, then secondary adjustment becomes mandatory. So yes, Secondary adjustment has to be done. Secondary adjustment becomes mandatory. Where adjustment is suo motu and the quantum of adjustment exceeds 1 crore, fine. Secondary adjustment becomes mandatory. In the instant case, secondary adjustment needs to be carried out. Within what date secondary money adjustment has to be repatriated? Part B. Okay. Money has to be repatriated. Okay. Money has to be repatriated within 90 days of due date of filing returns. Within 90 days of due date of filing returns. Okay. Due date is 30th November. Okay. So money needs to be repatriated. Okay. December 31, January 31, so 62 plus 28 days of February. December 31, January 31, 62 plus 28 days of Feb. Okay, money has to be repatriated on or before 28th Feb. On or before 28th Feb. Okay. Okay, whichever year it is, don't worry about the year. It's 28th Feb. Money has to be repatriated on or before 28th Feb. Assuming that the money has not been repatriated till 31st March and the assessee decides to pay additional car tax, what are all the consequences? Assume SBI rate to be 11%. Shall we read again? Assume that the money has not been repatriated till 31st March and the assessee decides to pay additional tax. Examination tension, what we will do is we will compute additional tax correctly, but unfortunately you should understand interest till 31st March also has to be computed. Within 90 days money is not repatriated. You are ready to pay additional tax on 31st March. So, both interest and additional tax. That's why what are I specifically wrote it as what are all the consequences, not just the additional tax. Okay. Part C. The consequences are interest from 1st December to 31st March. Transaction in INR, so SBI rate plus 3.25%. SBI rate plus 3.25%. Okay. B. Additional income tax on 31st March. These are all the two consequences. Now let us compute interest. Quantum of interest. Total secondary adjustment. We all know it is 6 crores. Total secondary adjustment. We all know it is 6 crores. Interest 11 plus 3.25%. 11 plus 3.25%. The law has said that it is 11 plus 3.25 in general. Okay, the question has said that the SBI rate is 11%. Okay, total interest, okay, which is 6 crores into 14.25% into December, Jan, Feb, March. Once more, December, Jan, Feb, March. 4 by 12. Okay, repeating, 6 crores into 14.25% into 4 by 12. Okay, this needs to be treated as income for the year ending 31st March. You should pass an entry, interest account debit, P&L account debit to interest or whatever, it is payable. Okay, or interest account debit to bank, whatever it is payable. Or it should be treated as income. Quantum of additional income tax, base tax at 18%, 6 crores into 18%, surcharge at 12%, irrespective of the level of income, surcharge is 12%, HEC at 4%. Total additional income tax payable, 1 crore 25 lakh 79,840. 1 crore 25 lakh 79,840. Once additional tax is paid, no more demand nor interest will be computed. You cannot also take credit of this additional tax anywhere. So next year he gave the money. You cannot take credit of this additional tax. (92C) 92CA is that multiple things. 92CB safe harbor rules, which is not there in our syllabus. 92CC and CD APA. 92CE is this entire adjustments of APA, secondary adjustment. 92CA reference to TPO. Okay, let me complete some things and come to the okay. Let's go to the administrative provisions of the law. All of us, this is now theory again. Let us go to the administrative provisions of the law. Okay, please understand, an assessing officer might not be technically qualified on TPO and all. We need specialists for that. Very soon, in a week's time or less than a week's time, when I am going to talk about faceless assessment, I am going to talk about something about technical unit, experts. So this TPO is an expert in transfer pricing. So what the assessing officer will do in the case of a TP case is, he will hand over the case to TPO, but assessment has to be completed only by the assessing officer. TPO is just a supporter and not the concluder. TPO is just a supporter, not the concluder. TPO will evaluate and give me a report. Based on that report, I will complete assessment. Okay, so in the process of assessment, I have come across some international transaction. Assessing officer, I have come across some international transaction. I am not very sure whether it is correct or not. So I transfer the case to TPO. Later I am going to say the case is transferred to technical unit. The assessment unit will transfer the case to technical unit. I am going to say that. Okay, now coming back. So I transfer the case to TPO and tell the TPO, boss, for this give me a report. Law tells in one word, in one sentence it is enough, though we are going to see. TPO becomes the AO now. And TPO gets all the powers of AO. That leads us to a question of what is the power AO has. Call for books, documents, information regarding the transaction. TPO can also do that. Call for books, documents, information regarding the transaction. Call for the personal attendance of the person. TPO also can do that. Call for return submission. TPO can also do that. AO in the process of assessment. AO is, okay, we will talk about this in assessment detail. AO is looking at your business income. At that time, he identifies that you also have an interest income which is not accounted. Can he assess that also? Yes. The law is in the future. We are going to study. For those who remember, recollect. For those who are new, leave it to me. Assessment procedure. Also, I will ensure that you are becoming strong. Such income or any other income. AO will assess such income, the business income, or any other income. TPO will assess the transaction referred by AO or any other transaction, which the AO has not referred, but I come to know now. Repeat, TPO can assess the transaction referred by AO, such transaction or any other transaction. The bottom line is, powers of TPO is similar to the powers of AO. One transaction is not at all recorded. You said such a transaction and any other transactions. This transaction is not at all recorded. Can the TPO take it? Yes. International transactions which are not recorded can also be taken up by the TPO. After going through all these things, after getting all evidence, everything, TPO will submit a report to the AO. Boss, this ALP is wrong, this is the ALP. Or the method is wrong, this is the method. AO is bound by the report of TPO. He cannot set aside the TPO's report. He cannot say, I will not believe you. You don't seem to be. I am supposed to complete my assessment based upon TPO's report. I am supposed to complete my assessment based upon TPO's report. TPO will submit the report within the last 60 days, and in the last 60 days I will complete the assessment. In the later stage you will understand, if I refer the case to TPO, my assessment period stands extended by 12 months. So within 10 months he will give. The last 60 days is for me. Okay, slowly. Section provides for a procedure for referring to TPO for computing ALP. The procedures in brief. Option to make the reference to TPO is only with the assessing officer. Assessee cannot say, you give the case to the TPO, he is my friend. This option is not available to the assessee, only the assessing officer. Assessing officer has to take the approval of commissioner before making it. TPO may either be a joint commissioner, deputy commissioner, etc. Okay. When such reference is made, this line is sufficient. Though all these things I have written, this line is sufficient. TPO gets the powers of AO. Whatever AO can do, TPO can also do. TPO will issue notice, making him produce books, documents, information which he relied upon in computing the ALP. AO will also do like that only. You have computed your net profit. Tell me what are all the things you relied upon for computing this profit. The same thing only AO also does, TPO also does. Where assessee fails to produce. Friends, leave it to me, this 131, 133 survey provisions, summons, you will read it. It's a power of AO, it's a power of TPO. I will make you understand it in day 2 of our assessment procedure class. TPO also has the power to go beyond. That's what I said. TPO also has the power to go beyond what has been referred to. He can verify other international transactions, whether it is reported or not. Okay? The TPO has to pass an order at least 60 days before the completion of assessment, determining the ALP after considering the evidence, documents, etc. provided and the material gathered by them. He has to send a copy of his order to AO and the assessee. Okay? The order of the TPO determining the ALP of an international transaction is binding on the AO. It means that AO has to proceed or close the assessment only on the basis of TPO's order. He cannot set aside TPO's order. He cannot set aside TPO's order. Sometimes what we do is, to complete this entire process, my dear friends, the TPO has to look for data from foreign countries. He has to look for data and information from foreign countries. There will be a period because TPO has to communicate to CBDT. CBDT has to communicate to the foreign ministry to that foreign ministry. There where the CBDT, in that the place where is the assessing officer, then the route has to be traveling like this. So there is a time period. That time period will stand extended. So the closure of assessment automatically stands extended. Okay, so those things, and he has to complete within 60 days, so automatically stands extended. And assessing officer has the power to rectify his mistake apparent on record, section 154. TPO is also AO. TPO has the power of AO. Hence, the power of rectification of any mistake is also available for the TPO. And we will see the provision that now it is going to be faceless. There is no more going to be physical reference to the TPO. It is only faceless reference to the TPO. Okay. In all the cases, we are going to see this provision for facilitating faceless assessment. Why faceless assessment? Greater efficiency, transparency, and accountability by eliminating the interface, direct meeting between the TPO and assessee or any other person. Ramadan, they are referring to us only. Okay, let us be honest. Okay, they could have written our chart accountant, but they are not written. Okay, between TPO and assessee or any other person to the extent technologically feasible. Okay, I'm a big supporter of faceless assessment. I'm a very, very big supporter, not going away. I'm just telling you that the most crucial thing, if my friend, some of my friends in the classroom will understand what I am saying. Okay, uh, after 25 years, if I can adopt to online teaching, faceless teaching is something which I cannot imagine of. I cannot imagine of. I miss physical classes like anything. Okay, if faceless teaching itself is possible, which should not be the order of the day. It is my opinion. It should not be the order of the day, especially in schools. We all enjoy it in schools. If I see school children sitting at home and studying school in geography, to learn geography, they don't need to go to school. The purpose is missing. Sorry for deviating, but if so, I wrote, if faceless classroom is possible, faceless assessment is easy. Faceless classroom, where it should not happen, it is happening. This is definitely, it saves time. So the travel time it is saving, no, that itself is enough. In a place like Mumbai, Chennai, Bangalore, we cannot imagine the travel time to go to income tax department, the waiting time, etc. So from starting from there to the end process of eliminating corruptions, etc. I'm a big supporter. So not now. Let's talk about this after you become CA. Okay, greater. Okay, so it eliminating, optimizing the utilization of information resources, and introducing a team-based assessment. This is one other thing I'll talk about it in faceless assessment. Okay, the same section 92 CA talks about the powers of AO. AO has the power to recompute ALP based upon the report. He has to, in fact, it's not a power, it's an obligation. Report of the TPO or otherwise. What is meant by or otherwise? Price charged or paid in an international transaction has not been determined by acceptable mode. Information and documents are not properly maintained, and the computation is not reliable. In these cases, AO. Where AO increases the income. This is what I said from the first time talking about it. I told you it is in some other place. Where the AO increases the income of the assessee, deduction or exemption shall not be allowed against the such increased income. We have been writing, I told you it is in some other place, I have completed. However, no adjustment shall be made without what is known as principle of natural justice. I should tell the assessee that I am making this. Additionally, it is mentioned that any adjustment in the books of the assessee, the resulting adjustment will not be made in the books of AAA, or in other words, TDS or other provision. You cannot now disallow 30%, etc. Okay, only it is increase in income. Okay, the main section for why you are all studying all these things is this. Okay, though this is not a questionable area, this is the section which says that honest person, the chart accountant, should be auditing and submit his report if it is more than 1 crore or so. Okay, okay. So this is how this mandatory audit provisions and from the top 92 operates. I'm not yet over. I have long way to travel. So quick recollection: 92 base rule, 92A associated enterprise, 92B international transaction as well as international transaction, 92B2 deemed international, 92BA specified domestic transaction, 92C the 5 methods of transfer pricing, 92CA reference to transfer pricing officer, 92CB not there in our coverage, safe harbor rules not yet notified, 92CC and CD APA, okay, advanced pricing agreement. I am skipping one section and went to 92E. 92D is pending documentation. D stands for documentation. Let us study that separately. Okay, that let us study that separately. Let us complete the other small areas and then go for documentation. 94A, special measures with persons located in NJA, notified jurisdictional area. Abdina, an area with which India does not have free information flow. NJA means we don't have free information flow with that area. Previously, Cyprus was there, removed. Whatever happening in the past 2 days makes me believe that one country is going to be declared by NJA very soon. The past 2 days makes me believe that that country is going to be declared. Okay? The problem here is, all of us listen. The problem here is any transaction with any person located in NJA will be treated as international, will be treated as transaction with an AE and TP provisions will apply. Shall I repeat? Any transaction, not necessarily it should have a bearing on the profit, cost, etc. Any transaction with, I am not using the word associated enterprise. I am using the word with any person. Any transaction with any person located in NJA, that person will be treated as my AE and it will come under TP regulation. First problem. Second, no concept of range or average price. Where there are more number of ALPs, the highest will prevail. Once more, 10 ALPs are there. Yesterday we saw 180, 200, that will only prevail. No 35%, no 65%. Or no weighted average or no assigning of values. Where there are more number of ALPs, highest will prevail. Third, no question of tolerance. That 3% tolerance is also not there. So shall I repeat? Shall I repeat together now, all of us? Any transaction with any person located in NJA will be considered, will be falling under TP regulation, and the other person will be considered as AE. The three detrimental points are, okay, one, where there are multiple ALPs, highest will only prevail. 2, tolerance limit is not there. 3, normally rate is whichever is less for other assessees. Here this will be whichever is higher. Rate specified under tax law, rates in force, Rates enforcement as per DTAA or 30%, whichever is higher. So a transaction with the NJA, a transaction with the NJA, a transaction with the NJA will be coming under lot of regulations. A transaction under NJA will be coming under lot of regulations, and the rates of TDS is also the highest rate will prevail. Normally, we are going to see in our DTAA 2 days from now. Normally, we are going to see where there is a conflict between DTAA and the tax law, whichever is more beneficial to the assessee will prevail. But here is a circumstance that there is no beneficial provision, only the higher thing. Okay. Friends, is the screen visible? My voice audible, friends? Can someone confirm?
So,
Yeah, thank you. So, this is the provision of NJA. Question number 22. A Limited, an Indian company, provides technical services to a company XYZ Incorporation located in NJA for a consideration of 40 lakhs in October. It charges 42 lakhs for similar services rendered to PQR Incorporation, which is not located in NJA. PQR is not an associated enterprise of A Limited. Discuss the tax implication with regard to, okay, be it all questions, this is the same answer we are going to write. Be it all questions, this is the same answer. Okay. So one question if I write, and it is applicable for the next two questions also. Any transaction with any person located in a NJA shall be considered as international transaction falling under TP regulations. Such other person who is located in NJA shall be treated as associated enterprise. Such other person who is located in that NJA will be treated as associated enterprise. I hope none of you is calling. I hope the class is visible. Visible, right? Am I audible?
yes, sir.
And the screen is visible, right?
Yes, sir.
Yeah, thank you. Okay, such other person, okay, in the given case, okay, XYZ Incorporation will be treated as AE of A Limited. Okay, ALP shall be rupees 42 lakhs. ALP shall be, okay, arm's length price shall be rupees 42 lakhs. Okay, assessee shall not have the benefits of, okay, tolerance, that is the 3% tolerance or wage concepts. Okay, assessee will not have the benefit of tolerance or wage concepts. question number 23. Okay, one of the feedbacks I received yesterday was to give a couple of extra minutes to complete the thing and go to the. I will definitely try it, but as the class goes by, we will be stuck with time, but I will keep that in my mind. Okay, keep that in my mind. Alpha Limited, the assessee has sold the goods to Beta Limited, which is located in NJA. The CIF value of 4,000 metric tons is 4 crores. Beta Limited is an absolute stranger to Alpha Limited. No chance you are an AE. Will the TP provisions apply and will these two companies be regarded as AE? Okay, following on the further data. Identical goods sold to H Limited Sydney 10,200 and transaction net margin method price is 10,180. Normally what we will do if the assessee is not in NJA, ALP will be 10,180 plus 10,200 divided by 2. Since there are only two values, take the average. But here the assessee, the other person, the transacting party is in NJA. If TP provisions are applicable, what will be the impact? Okay. Beta Incorporation is an AE of Alpha, even though there exists no control or voting or other aspects. The base law is any transaction with any person in an NJA that other person will be treated as AE and the provisions of TP shall apply. Okay, this is the base law, you cannot change it, so it is in this case also TP will apply. Okay, will the TP provisions apply and will these two companies be? Yes, for okay. Where there are multiple prices available, normally we either go by average or range concept. However, where the transacting party is in an NJA, the highest price will prevail. Okay, where the transacting party is in a notified jurisdictional area, this range etc. will not, the highest price will prevail. Okay, ALP is, we all know it is 10,200. Okay, we all know it is 10,200 less actual transaction value. The question says 4,000 metric ton, 4 crores. Okay, 4 crores divided by 4,000 metric ton. 4 crores divided by 4,000 metric tons. Therefore, increase in income per metric ton. Okay, 10,200 minus 10,200. Overall increase in income. Overall increase in income is 4,000 metric ton into 200, 8 lakhs. The 24th question I am not answering, I'm just leaving it as it is. Haji Musa, the assessee, is a domestic company, exported bananas to Mystery Incorporation for 81 lakh. Mystery Incorporation is located in NJA, is not an associate with the assessee in any manner whatsoever. During the year, the assessee billed 84 and 86 lakhs for sale of similar goods of identical quantity to Sun and Moon Incorporation in Kuala Lumpur, which is not in an NJA, and both of which are not associated. The permissible variation, that is tolerance limit, is 5%, which is not there for NJAs. The management wants to know the tax implication. Theory answer, the material will have the answer. 86 lakhs will be there, no tolerance, nothing, okay, will be there. Okay, it is 94A, which is NJA transaction, which is not a questionable area in my opinion. But here comes the questionable area. 94B, limitation of interest. Limitation of interest. The section should have stopped there. Limitation of interest. What is this? This is simply your financial management which you do, that whether to invest as equity or debt. If you invest it as equity, you might be the owner of the entity, but the problem is returns are going to be only if there is profit, uncertainty, and after tax. Whereas if it is debt, it is pre-tax return certainty. So multinationals started investing in debt more than equity. Okay. This is utilized as an excessive advantage by various MNC, started contributing more as debt than equity. So BEPS, okay, profit got eroded, so they brought a norm. The Indian context says maximum allowable interest is total interest paid or payable in excess of allowable interest in excess வரக்கூடாது. Okay, 30% of EBI TDA or actual interest paid, whichever is less. 30% of EBI TDA, earnings before interest, tax, depreciation and amortization. Amortization is not an Indian context, so let us leave that. Or actual interest paid, whichever is less. However, this provision is not applicable if the total interest does not exceed 1 crore. The excess interest which is disallowed, it is like a MAT credit. It is like a GST credit, can be carried forward and adjusted in the subsequent years within 8 years. This is an amendment. The provision is not applicable for interest paid to branches of a foreign bank. Okay, because obviously you understand the logic. Bank should not come under this. Maybe a questionable area. Okay. A German company started an 100% Indian subsidiary investing 25 lakh euros, INR 80 per euro, out of which 5 lakh euros as capital and the balance as debt, on which the Indian entity is liable to pay an interest of 15%. For the year ended, the profit after claiming depreciation amounted to after claiming interest and depreciation of 41 lakhs is rupees 3 crore 20, 3.2 crores. Compute the disallowance warranted by section 94B and specify the income. The German company started an 100% Indian subsidiary. Okay, the German company and the Indian entity are having a holding subset relationship, so they become associated enterprises. Okay, total loan provided by German entity. Out of the 25,000, 25 lakh, 20 lakhs into 80. 20 lakhs into 80. Okay, here I 20 lakhs into 80. That is how interest payable, interest payable at 15%. Interest payable, interest of 15 at 15%. 2 crore 40 lakhs. Okay. Computation of maximum interest allowed under section 94B. Computation of maximum interest allowed under section 94B. The total interest exceeds rupees 1 crore, hence 94B becomes applicable. The total interest exceeds 1 crore, 94B becomes applicable. Net profit, net profit 3 crore 20 lakhs. And depreciation 41 lakhs. Interest 2 crore 40 lakhs. Earnings before interest, tax, depreciation, and amortization. Though amortization in Western countries, for intangibles they call it as amortization, but Indian law we call it as depreciation only. EBI, TBA. 6 crore 1 lakh. 6 crore 1 lakh less maximum interest 30% of EBI TDA. 30% of EBI TDA. 30% of EBI TDA or okay actual interest. In this case 2 crore 40 lakhs. Okay, whichever is less, whichever is less. Revised profit. Revised profit. So this is the interest that is allowed. This is the interest that is allowed. This is the interest that is allowed. Okay. The difference between interest paid and interest allowed. I paid 240, but I claimed only 180. 59 lakh 70,000. This can be carried forward and adjusted again and added to interest in the year in which actual interest is lesser than 30% of EBI TDA. Do you understand? In 1 year, suppose this is only 1 crore 50 lakhs, whereas this is, so in that year you go and add it, you claim it in that year. Okay, maximum period of carry forward 8 assessment years, maximum period of carry. So this is known as excess interest. Kiwi LLC is a foreign company incorporated in Singapore. Bright Star Incorporation is a foreign company incorporated in Australia. Daflots Private Limited is an Indian company. The Indian company has taken a loan of 120 crores from Moonshine Incorporation, a foreign company, at the rate of 10% on 1st October. The guarantee of that is given by Bright Star Incorporation. So more than 10% of the guarantee, if it is so. This is the only loan taken by DPL. Kiwi LLC holds 27% of BI as well as DPL. One person holding in two entities 26% or more. Both these entities also are known as associated enterprise. The net profit of DPL after interest and depreciation 1.8 crore, but before income tax. Okay, so before income tax. Income tax liability may be taken as 1.2. Is any disallowance warranted in the hands of DPL as the transfer pricing provision appends suitable notes? Okay. Okay. Where one person holds 26% or more of voting power in two different entities, then they both also shall be treated as associated enterprise. They both also shall be treated as associated enterprise. Holding 26% or more in two different entities, they both will also be treated as associated enterprise. Okay. Guarantee is covered under international transaction. Directly, this is covered under international transaction. So this note will make the answer very different. That is, not only you are answering for the provision, you are answering for the holistic law. Okay, right? Fine. Computation of maximum permissible interest. If you remember 94B. Okay, net profit before tax. They themselves has given before tax. Net profit before tax 1 point. The net profit after above interest and depreciation of 1 point, but before income tax is 9.2 crores. 9 crore 20 lakhs. And depreciation 1 crore 80 lakhs. Interest The company had taken a loan of 120 crores at a 10% on 1st October 2020. So 6 months interest. Okay, 120 crores into 10% into 6 by 12. Okay, 120 crores into 10% into 6 by 12. Okay, 6 crores, 120 crores. Okay, not 1.20, 120 crores. Earnings before, you can add 1 point also, the total interest exceeds 1 crore, so 94B is applicable, so that our answer becomes more clear. Earnings before interest, tax, depreciation and amortization. Yes, 94B restriction. 30% of EBITDA. Actual interest. Whichever is less. Okay, revised profit. Okay, okay. May I? Okay, so this is our 94B restriction. Okay, with this, we have completed the major part of practical understanding. Now goes the last part of documentation. Friends, hope it's audible, friends. Shall we progress?
Yes, sir.
Yeah, thank you. Friends, the last arena of transfer pricing is about documentation, which has undergone some changes in the recent times. So there can be a question there also. Well, what type of changes? What is this documentation? The only way we can prove, we means assessee, the only way assessee can prove to the assessing officer that my prices are correct, that my ALP is correct, is by maintaining proper documentation. Similarly, the department also looks for documentation. So documentation is the key. The documentation in the recent times has undergone a change. There are 3 levels of documentation. There are 3 levels of documentation. Local file, master file, country by country reporting. If we remember our travel, I did not go through 92D. I just jumped to 92E. Okay. Okay. After 92CC, I just jumped to. So 92D is something pending. Okay. That's where I'm coming to. Local file is one which is maintained by our assessee, the Indian assessee. Master file is also by the Indian assessee. Circumstances are different. Country by country reporting is also by the Indian assessee with differential and requirements being the different. Records to be maintained. This is to prove that my ALP or to make the department, because I told you TPO will call for details. What detail he will call for? Books of accounts are there, but what other detail? This is where it comes. The primary objective of TP documentation is to review ALP, nature of transaction taking place between them. Before going into, let me give you a bird's eye view from the larger perspective. Let us look at it. Coca-Cola International in US, Atlanta, US, parent company. Hindustan Coca-Cola Limited. We call them as, the law calls them as constituent entity. Repeat. Parent. I am one of the entity in that group. I am known as the constituent entity. Like me, there are so many Coca-Colas across the world. All of them are constituent entities. Suppose Coca-Cola is also manufacturing water and in a different name. So, in India itself, there can be more than one constituent entity. There can be more than one constituent entity of an international group. There can be more than one constituent entity of the international group. So where are we traveling? Parent, constituent. Sometimes this parent will say, majority of the parent companies, ABC, Google's parent alphabets, are all investing companies. Majority of the parent company are not operating companies. Please understand, they are all investing company. Investment, they will have a separate company. So they will say, though I am the parent company, I don't like to report this company, Google will report, or some other company will report. Normally, who should report? Parent should report. But parent says, I am just an investing company, boss. Let the other fellow start reporting. We call the other fellow as alternative reporting entity. We don't even call them reporting entity. We call them as alternative reporting entity. Because parent should report, alternatively some other person is reporting, so that other person is known as alternative reporting entity. So three things we understood: parent, alternative reporting entity, constituent entity. Sometimes the Indian entity can also be the alternative reporting entity. The Indian entity can also be alternative reporting entity. The Indian entity can also be parent entity, Infosys, parent entity, HCL, parent entity, TCS, parent entity. Okay? So parent entity, constituent entity, alternative reporting entity. This section imposes a responsibility on every person who enters into an international transaction or a constituent entity of an international group. See, please understand the difference. Who enters into an international transaction, they have to report. Who is a constituent entity, even if they are not having an international transaction. Sir, Hindustan Coca-Cola and Coca-Cola International does not have any transaction. Should I report? Yes, sir, because you are a constituent entity. This section responsibility, who enters into an international transaction or a constituent entity. The constituent entity is required to keep and maintain information and document. The constituent entity is required to keep and maintain information and document of the fact whether or not they have any international transaction. Whether if you are having international transaction, boss, maintain all documentation. You need not be a reporting entity, constituent entity, or parent entity. Maintain document. Sir, I don't have international transactions, sir, but I am a subsidiary of an American company, sir. Maintain documentation. Sir, I don't have international transaction. You are a constituent entity. Maintain document. AO may require any person to furnish. AO here can also be TPO. Okay? Or document within a period of 30 years from the date of notice. The requisition period may be extended based upon it. What are all the details you have to maintain? Description of the ownership structure of the assessee with details of shares or other ownership interest of other enterprise. Which multinational group you are involved? What are they doing? Broad description of the business of the assessee and the industry in which the assessee operates. What's your nature of business? I'm in software segment. Worldwide software segment has platform developers, back-end providers, just service providers for software, operations only carried on by software, all these things. Okay? The nature and item of international transaction entered into with AE. Functions performed, risk assumed for analysis. Record of market. Okay, for analysis, you can write directly. Record of uncontrolled transaction. Now coming to who are all your independent parties with you who are transacting. Analysis which you are performing. What are all the critical assumptions you are making for determining your ALP? Okay, a description of the method and what are all the parameters for selecting that particular method. Assumptions, policies, and price negotiations which affect, okay, any other data. These needs to be maintained. This is known as local file 92D. If you have international transaction, maintain. If you don't have international transaction also, if you are a constituent entity, maintain. Maintain it for 8 years. Only benefit I am giving you is if your turnover does not exceed 1 crore, no problem, don't maintain. But constituent entity should maintain. Then comes the two other things called master file and CBC reporting, country by country reporting. Okay, so a master file, these are by base OECD norms. Okay, master file, local file, which we have already seen, and something known as country by country reporting. This is nothing but consolidated financial statements of the whole group. Consolidated financial statements of the whole group. First time I'm going, only time I'm going out of section 92 and taking up 286. I told you after 92, 286 is the TP regulation, country by country reporting. CBC, country by country reporting. Who should? Let me go subsection wise, same manner let us go. Subsection 1. Who should report? Every constituent entity resident in India of an international group shall report to DGIT, Director General of Income Tax, at least 2 months prior to the due date of furnishing CBC. What is that they have to report? Whether they are the alternative reporting entity. What is alternative reporting entity? Parent entity says, I am not going to report, this fellow will report on behalf of me. So the Indian entity should say, am I the alternative reporting entity and the group to which I belong to? If I am not the alternative reporting entity, then who is that? Okay, sir, I am not that, sir. Okay, who is that? Which country? Who is going to be? If your parent is going to report, fine. Or has your parent appointed any other person? Fine. And the country or territory in which they are resident. So, first thing, 2 months before due date, what I should, I'm not now reporting, I'm just saying whether I am the alternative reporting entity. Yes, sir, I'm not that. Then who is that? Who is your parent entity if they are going to report? Or who is your alternative reporting entity and where are they located? If I am the alternative reporting entity, time limit is 12 months from the end of the financial report year. If I am the parent entity or alternative reporting entity, then I need to file. What should I say, sir? What are all the things I should say? In the consolidated financial statement will have revenue, capital, employment, asset, tax, country wise. Have all the countries as columns. Last a total. Here I am going to link with poem guidelines. Very soon I am going to link poem guidelines here. So, contents of CBC. Okay, the country by country reporting is what is the revenue country wise, capital country wise, employment country wise, asset country wise, tax country wise. I am a constituent entity. I means the Indian entity is a constituent entity. When is my reporting? This is the most important subsection. Responsibilities. The provisions are applicable if the resident entity is not the parent entity or AR. If I am the parent entity or alternative reporting, subsection 3, 2 and 3 is sufficient. Report it, what I have to report, within what time I have to report. Suppose if I am not the reporting entity, still am I responsible? Yes. Understand the case. If your reporting entity is in a country with which India does not have free exchange of information, if your reporting entity is in a country in which India does not have free exchange of relationship, then you also report. Let them report, you also report. Or your reporting entity is located in a country where CBC is not mandatory. Shall I repeat? When is I am not a parent entity, I am not an alternative reporting entity, still I am liable to report. When two circumstances. One, if the reporting entity or the parent entity is located in a country with which HIA, with which India does not have free exchange of information. If the country in which your reporting or parent entity is there does not warrant CBC, okay, the responsibility depends on parent entity is liable to file CBC or not. Where the parent entity is not liable to file CBC in their territory, then every constituent entity shall be liable for it. Indian reporting entity is liable to prepare CBC if the parent entity or the alternative, as if it is the parent entity or alternative entity is located in a country with which India does not have free exchange of information. It should not be a full stop, it should only be a comma. Sorry, it's not a full stop, it's a comma. Indian resident entity is liable to prepare CBC if the parent entity or alternative reporting entity is located in a country with which India does not have free exchange of implication. I told you, I have 2 or 3 reporting entities in India. Let one alone, the constituent, 2 or 3 constituent entity in India. If there are more than one such constituent entity of the group resident in India, other than the parent or heredity, then the group can nominate one constituent entity for furnishing. So the reverse of this is no obligation. If the parent entity or ARE has filed in the designated tax jurisdiction and the report can be obtained, there is a free exchange of information, then it's okay, boss, you need not file. Okay. DGIT is empowered under this to call for such documents, administrative provision, threshold limit for local file 1 crore. Here, I'm sorry. I'm sorry, friends. Okay. What happened yesterday, this morning, for 1 hour munadi, when I'm preparing only, I saw something. 1 minute. There is a judicial, I'm sorry, update released by the institute, statutory update released by our institute, which has changed it to 6,400 crores. Which has changed this to, okay, let me not waste time on that. This has been changed to 6,000. Just now I saw, before the class I saw that. Okay, this is rupees 6,400 crores. Those who have not taken the printout, please mark somewhere. The limit is no more 5,500, 6,400 crores. Okay, this is CBC, the only place where we go out of 92. Otherwise, everything is 92. This is master file. Okay, 92D read along with the 10D. Master file is a condensed form of CBC. That's all. Every person being a constituent entity has to keep and maintain prescribed data of the group. This has to be maintained irrespective of the fact whether you have international transaction or not. Here, the threshold limit is 500 crores and the international transaction exceeds 50 crores. Okay, so it's a combination of group revenue exceeding 500 crores and plus any of these one. Intangibles exceeds 10 crores or revenue exceeds 50 crores. So this is the limit. Okay, for this TT buying rate is used for conversion, and it is the same information which you have in the local file which needs to be maintained. List of all entities in the international group, legal status, nature of business, the nature of supply, for analysis, same things which you have to maintain and file. Not different from anything. Same 8-year, same only one entity. If there are more entities on or before the due date, you need to file it. This is the master file. For local file, 1 crore. For master file, 500 crores plus either 50 crores of revenue or 10 crores of assets transaction. CBC 6,400 crores. The last part where I will be relying more on the answers which is already there. What is the binding nature of ALP determined by TPO? The report of the TPO cannot be set aside. It should be considered by the assessing officer for preparing its report. Assessment can be completed only based upon TPO's report. Where any reference is made by AO to the TPO under 92 CA, what are the procedures to be followed by TPO? Can TPO exercise his jurisdiction or any entity not referred to by him? Yes. The powers of TPO is typical to the powers of AO. He can call for documents, examine witness, etc. And he can go into aspect which is not referred to him also. Okay? Which is not reported also. Enumerate the consequences that would ensue if the AO makes adjustment to ALP of the assessee resulting in increase in what are all the remedies available. Okay, no exemptions, no benefits can be claimed. Only remedy is appeal. Only remedy is appeal. Okay. Janak Limited is Associated Enterprises of Tokyo. The latter has a permanent establishment in India. The company rendered services to Janak Limited for which tax was deducted at source and remitted. The ALP of Takayo Incorporation was recomputed during the transfer pricing assessment. Janak Limited wants to know whether there will be any subsequent recomputation. No. Okay? No. Just because a piece thing is recomputed, it will not result in yours. Okay? There is no secondary adjustment involved here. TP will not be applicable for book profits. Book profit is 115 JB. TP will not be applicable for book profits. Can complete the assessment of a TP's report. TPO report has to be considered. He cannot disregard. He cannot set aside. He has to consider it. Okay. Kohli Limited is the dealer of goods manufactured by Bradman Incorporation. Bradman Incorporation owns 55% of shares in Kohli Limited. Out of the 7 directors, 4 were appointed. The AO, after verification of transaction of 300 lakhs of Kohli Limited for the relevant year, and by noticing that the company has failed to maintain requisite record and also obtain auditor's report, adjusted its income, made an addition of 30 lakhs to the declared income, issued show cause notice for penalty. Yes, penalty is leviable. That is the last part which I have mentioned. Okay, this is the penalty. Okay, 2% of international transaction value. 2%. If you don't maintain, okay, failure to maintain documents, failure to report, okay, 2% of international transaction value, or failure to get it audited, 1 lakh. Okay, failure to get it audited, 1 lakh. This you already know. 270A, 50% of tax for underreporting. If you don't know, it is my duty to make you know at the right time. CBC reporting penalties. Please remember, it is for CBC. Failure is more than 1 month, 5,000 per day. I mean, not more than, less than 1 month. More than 1 month, 10,000 per day. I have served a notice, still you are not reporting, 50,000 per day. Continuous offense. Incorrect information, 5 lakhs. Okay, before going into the exams, once if you can look at it, it will be better, more on memory power than on anything else. Okay, this is our transfer pricing discussion. This is our transfer pricing discussion. I am very confident that we have covered at its length and breadth everything of 92 and 286, and you will be able to easily take up any questions on transfer pricing. Without much difficulty, you will be able to score. If there are 10 marks, 10 out of 10 is my intention in transfer pricing. Let's see. Okay, if it is a penalty and we don't remember that in a objective type question, that's different. But generally, I'm very confident that you will score the maximum, and this is with regard to transfer pricing provisions. Okay, in my opinion, we have done sufficient questions. Review this. Since exams there is time, you can just prepare it once more and see. Okay, that will be more than sufficient for transfer pricing. For new learners also, I'm saying this is more than sufficient in transfer pricing. Okay, I am moving on to the next area, which is popularly known as non-resident taxation. In terms of discussion, it is more than transfer pricing. In terms of discussion, it covers a big area than transfer pricing. In terms of marks, probably it will be equivalent to or lesser than, but in terms of discussion, and also in terms of memory, it is also occupying more memory, is my opinion. Okay, because of rates has to be remembered, but rates can wait. First, let us understand what is this non-resident taxation all about. We are going to cover in this residential status of an assessee. When I will call him as a non-resident. Based upon his residential status, how to compute the income in India, scope of total income. Then I go to section 115, special rates and provisions applicable for non-residents. And also it will match with the TDS rates, so I have given it here itself. Then coming back to PGBP, we will also check presumptive taxation. 44 AB, 44B, 44 triple B, like that. Then even before that, we would have claimed some exemptions. The last part will also cover some special provisions applicable for units located in Gift City, Ahmedabad, Gujarat. IFSC, International Financial Service Center. So I told you, in terms of discussion, it is going to be more. It's also going to be interesting in terms of discussion. In terms of marks, let's not worry about it. Our duty is to get maximum marks. I start with who is a non-resident. Okay, we should be able to cover this part of the discussion along with the tail piece of information today, hopefully. Okay, let's see. Who is a non-resident? In the case of individuals, one who does not satisfy the basic condition is a non-resident. Shall I repeat? In the case of individuals, one who does not satisfy the basic condition is a non-resident. That leads us to the discussion, what is that basic condition? The first basic condition, all of us will sleep until 182 days or more. The second basic condition is 60 plus 365. 60 days in for all of us 2021, 365 days in together in 1920, 1819, 1718, 1617. These 4 years put together 365. So it is 60 plus 365. But the second basic condition is not applicable for 3 different categories of assessments. Second basic condition is not applicable for them. Indian citizen leaving India for employment. Suppose today you leave India for employment and it is less than 182 days, let it be more than 60 days also, no problem, sir. You are a non-resident. Indian citizen leaving India for the purpose of employment. Member of a ship crew. Ship keeps sailing in the territorial waters of India. That doesn't mean he is in India. He cannot get down. So, ship which is sailing in the territorial waters of India. Indian citizens or persons of Indian origin visiting India. The second basic condition is not applicable. For them, the first basic condition is only applicable. But unfortunately, for no reason I don't know, the law has been amended for them. The law has been amended for this category of people. Okay. Indian citizens or persons of Indian origin visiting India. Okay. Indian citizen. PIO stands for either the assessee or his parents or grandparents are born in undivided India before independence. Okay, fine. Indian citizens or PIO visiting India. There is an amendment in the current year. Basically, our income is divided broadly into two. Indian income received in India, accruing or arising from India. The word deems is also there, but received in India, accruing or arising from India. Foreign income, business or profession which is operated outside India but managed from India. Any other income which is in the nature of rent, dividend, interest, sale, etc. Any other income accruing outside India and accruing outside India and received outside India. Basically, income is divided into two: Indian income, foreign income. What is Indian income? Received in India, accruing or arising from India. What is foreign income? Business or profession which is outside India but managed from India. Any other income, rent, dividend, sale, interest, accruing outside India. So, there is an amendment. There is an amendment. Okay? Where the total income other than foreign income except business or profession managed from India exceeds rupees 15 lakhs, then the 60 days appearing in basic condition 2 will be substituted with 120 days. So the 62 days difference, because more than 182 first condition itself, I will never come to second condition. When will I come to second condition? Only if first condition is not fulfilled. Here, instead of 60 plus 365, it should be 120 plus 365. When? If the total income other than foreign income, with that they did not stop, except, so if these three things exceeds 15 lakhs, if these three things exceed 15 lakhs, then if these three things exceed 15 lakhs, then the 60 days appearing in basic condition B will be substituted with 120 days. The 60 days appearing in basic condition B will be substituted with 120 days. It will be 120 plus 365 for this category of people. Normally for them basic condition 2 is not applicable. But then amendment has been brought around and they will be treated as RNOR, which means additional condition you need not check. They will only because of this condition. So to understand it better, is the total income less than 15 lakhs? Second basic condition not applicable. Is the total income more than 15 lakhs? Total income other than last category income. Then second basic condition will be 120 plus 365 instead of 60 plus 365. Mr. Swadesh is an Indian citizen currently in employment outside India. He has visited India during the past few years as follows: 2021, only 58 days; 1920, 1819, 1718, 1617, 1516, 1415, 1314, 1213. The total income of Mr. Swadesh accruing or arising from India 11 lakhs, from a business which is managed from India 3 lakhs, and total income earned and received outside India 7 lakhs. Swadesh wants to understand his residential status under various circumstances. For the financial year 21-22, Swadesh is planning to come to India on 1st May and wishes to stay till 31st August. Advise him suitably. Read it. Period of stay during financial year 2021, 58 days. He is neither satisfying the first basic condition nor satisfying the first basic condition, and the second basic condition is not applicable for him. Hence, he is a non-resident. Why do I say second basic condition is not applicable? Total income other than foreign source income, Indian income, is 11 lakhs. Business or profession outside India but managed from India. Business or profession outside India but managed from India 3 lakhs. Total 14 lakhs. So I need not test. That's why I said 58 days down 60 lakhs. So second basic condition is not applicable to him. Even if it had been 68 days, 78 days, up to 190 days, no problem. No problem. But we need to answer not only that, we need to answer for financial year 21-22 also, where they are asking us whether he can come and stay. Proposed period of stay in India. Proposed period of stay, he is planning to come on 1st May and leave on 31st August. May plus June plus July plus August. 123 days. 123 days. Proposed stay in India during financial year 21-22. 123 days. Past 4 years, which will be 2021, 1920, 1819, and 1718. Okay, are 58, 200, 240, 175. 58 plus 200 plus 240 plus 175 plus 175. Let's look. 58 plus 200 plus 240 plus 175. 673 days. 673 days. Okay. Suppose if the total income, I'll directly write the provision. Total income received in India plus accruing or arising from India plus business or profession outside India but managed from India exceeds rupees 15 lakhs, then he will become a resident India and provisions of RNOR will become applicable. Okay. Suppose if he is having total, here it is 14 lakhs, up to 14 lakhs, okay. Suppose this becomes 6 lakhs. So it exceeds 15 lakhs and this 120 days criteria is fulfilled, he will. So our advice will be don't stay till 30. If this is true, if this is not true, stay. If this is true, if it is going to exceed 15 lakhs or you plan it might increase 15 lakhs, ask him to leave on August 27th. Conclusion. Where non-resident status has to be retained, then Swadesh has to leave on or before 27th August. Okay, in the condition that it exceeds 15 days. While writing the theory, if I had made a small mistake, I have just written foreign income. I should have written total income. So kindly change the point. Please use this theory. The same is now applicable for what is popularly known as deemed resident, a new concept under section 6 subsection 1A. Section 6 subsection 1A, deemed resident. A new concept has evolved in the name of deemed resident. Total income mentioned above does not exceed 15 lakhs. Same. Total income means other than foreign income, but foreign income will not include. So these three things exceeds 15 lakhs. He is an Indian citizen. He is not taxable anywhere else due to his domicile or residential status. People can easily plan today 100 days of stay in India, 100 days of stay in Germany, 100 days of stay in US, 65 days of stay in other parts of the world. Nowhere you would have become a resident. It is possible today. Many businessmen can do that because they are having business across the world. They can do it. If you plan, you can make it happen. So the law says you are an Indian citizen. Your income is more than 15 lakhs. Your income is more than 15 lakhs, except foreign income which is earned and accrued outside India, received outside India, and you are not taxable in any part of the world due to your citizenship or residential status, then you are my man. You are known as a deemed resident. Provisions of RNOR will become applicable. You will be considered as my man, and the provisions of RNOR will become applicable. All these things are amendments, so I'm changing the color so that you are very clear. I request you to look into this along with the practical question to understand, because there in the theory I made a mistake while writing that it is a foreign in. Originally my understanding was little different, and further I did not correct it. In case of Indian who is being outside India, visits India, will become a resident. The total Indian income, that is the mistake. The total income, including this income, okay, that is where the mistake I made. That my original understanding of what the finance minister was thinking was wrong. So kindly use the Excel sheet, okay, and I will change it before I will, if needed, I will release it new material also. Okay. In both the cases, if all the both the cases are and OR provisions are only applicable. So in the case of individuals, this is the aspect. In the case of individuals, this is the aspect. Okay. HUF, firm, AOP, BOI, everything is on the basis of control and management. Only if it is outside India. Wholly outside India, then it is non-resident. Wholly outside India, then it is non-resident. Even if it is partly in India, it is a resident. Okay? HUF can also have the status of RNOR. HUF can also have the status of RNOR because the Karta satisfying the additional condition, but others, don't worry, non-resident, only non-resident are important. Let us go into the most important discussion, which is known as poem. For companies, how do you say something is a resident company, or how do you say it is a non-resident company? Okay, that is where I am going into. A company will be treated as a resident company. A company will be treated as a resident company if it is incorporated in India. I am not bothered where it is managed, etc. If you are incorporated in India, you are a resident company, sir. Let your whole management be outside India. I am not bothered, sir. If your company is incorporated under the Indian company law, you are a resident company. If your company is incorporated outside India, but the place of effective management is in India. The reverse I will never talk. If you are incorporated in India, irrespective of where your poem is, you are in my man. You are an Indian company. But suppose if your company is incorporated outside India, and the place of effective management is in India, then you are a resident company. What is this place of effective management which we are speaking about? Then came the circular number 6 and 8, which specifies about poem. Remember, law stops with the saying, if your place of effective management is in India, you are an Indian entity, and left it to the subordinate legislation for CBDT to explain. The CBDT circular goes by elimination rule. The CBDT circular says, when you are a foreign company, when your place of effective management is outside India, it does not directly define. In fact, if you read the additional conditions of Act, it is directly definition correct. He is a non-resident in India in 9 out of 10 years. But we change it to, for our easy understanding, we change it to, he is a resident in India 2 out of 10 years. His stay period in some. But in law, elimination rule. So here also, elimination technique. When will I consider that you are conducting business outside India? When will I consider that you are conducting business outside India, active business outside India? It depends upon your board meetings where it is held and your operations where it is held. Two criteria are important for me. Where are you conducting your board meeting? Where are your operations? First, let me come to operations. If 50% or more of your income is from outside India, you are not my man, go. If 50% or more of your assets are outside India, go. If 50% or more of your employees are outside India, If 50% or more of the payroll cost is outside India, you are not my man, you can go. So, elimination technique, we will understand it in our fashion. When will poem be in India? If 50% or more of they are using an interesting word, passive income. I will come to that. If 50% or more of the passive income is in India, you might have incorporated your company everywhere, but you are my man. If 50% of the or more of the assets of the company are located in India, if 50% or more of the employees of the companies are located in India, or 50% or more of the payroll cost is incurred in India, that means irrespective of your place of incorporation, you are my man. You are my man. Passive income, where both the transacting parties are AE, both buyer and seller are AE, and any other source of income is passive income. Business income, if both are AE, it is known as passive income. Any other source income is also known as passive income. Assets take the average of opening and closing, so is employees, so is payroll cost. If this is the first year, only the closing balance. On the basis of board meeting. If majority of the board meetings are held outside India, then you are not an Indian entity. So in other words, if majority is held in India, irrespective of your place of incorporation, you are a resident entity. Now arises another circumstance. Board is not the decision-making authority. Board is giving it to some governing body or some executive body. We can relate, no? Where half or more of the directors of one company or the governing body of one company or the executive directors of one company is appointed by another company, they are known as associated enterprise. If board is not exercising its power, and such powers are exercised either by holding company or any other person resident in India. Suppose board of directors is not the decision makers, then the key decision makers, key managerial personnel. Okay, these are also meaning that but only core decisions. Don't go for operational day-to-day decision. Just because there is a shareholders meeting in India, it is not poem, is not India. Operational and day-to-day decisions are not there. Merely because some PE is in India, it doesn't mean poem is in India. And the whole circular is applicable if the turnover exceeds 50 crores. Read through. Sugar. all conditions are mutually exclusive, not that only one should be fulfilled. All conditions are mutually exclusive. I come to question number 2. It's more about scope of total income. Question number 3. Infosys Incorporation is a sourcing entity of Infosys India. Infosys Incorporation is incorporated in Germany as a 100% subsidiary of Infosys India. Warehouses and stock are the only assets of the company and are located in Germany. All the employees of the company are also in Germany. The income breakup for the past 3 years. 30% of income is from transactions where purchases were made from parties which are non-associated and sold to associated, not a passive income. Both are associated only part. 30% of income where purchases are made from parties associated, sold to associate. This is passive income. 30% where purchases are made from parties which are sold to non-associates, not passive. 10% other way. Okay. Part A. Passive income is both the transacting parties are AE plus other incomes. In the given case, 30 plus 10. 40% of passive income is in India. The rest 60% is outside India. Based upon income condition, the German company does not have the German company does not have the poem in only 40% remaining. Only if it is more than 50% we will consider. Other factors remaining constant in the example. If Infosys Germany has totally 50 employees, 47 of them in Germany, 3 key employees are in India. The total payroll cost is 5 crores and 3 crores is for the 3 employees. on the basis of payroll. Total payroll cost 5 crores. Payroll cost in India 3 crores. Percentage of payroll cost in India, okay, since it exceeds 50%, poem is poem is satisfied and poem is satisfied and the German entity becomes a resident Indian entity. Poem is satisfied and the German entity becomes a resident Indian entity. Other factors remaining constant. It should be part 3 actually. In the example, if totally 5 board of directors meetings are conducted, out of which 3 are in India. The agreement between the companies specified that Infosys Incorporation can sign any contracts of a value less than 10 lakhs on their own. For contracts more than 10 lakhs, permission needs to be obtained from Infosys India on the basis of decision making. Strategic decisions are made in India. Only operational decisions are made in Germany. We all understand they have a limited power up to 10 lakhs. More than 10 lakhs, all strategic decisions are made in India based on that poem is satisfied. It's a very rare condition, but general. Key decisions, key managerial personas are in India. Question number 4. An Indian multinational group has a local holding company A Co in country X. The ACO also has 100% downstream subsidiaries, BCO and CCO in country X and DCO in country Y. A company has income only by way of dividend and interest from investment made in its subsidiary. The place of effective management of a company is in India and is exercised by the ultimate parent company of the group. The subsidiaries B company, C company and D companies are engaged in active businesses outside India. The meetings of the board of directors of the considerate are also held in their respective countries. Comment on poem applicability. Read through. Please understand, B company, C company and D company are not Indian residents at all. Just because they are subsidiaries or even subsidiary, it doesn't mean poem is fulfilled. What is poem? Poem depends upon, is the income earned in India? No. Employees? No. Payroll? No. Assets? No. Is the board meetings majorly held in India? No. Then just because shareholding you cannot. These are all the criteria for determining poem. Look at the question. A Indian multinational group has a holding company, A company in country X. The A company has B company, C company, D company. A company has income only by way of dividend, interest, etc. The place of effective management of A company is in India. Does that mean B, C, D are also in India? No. Everything should be independently tested. Poem of a parent entity in India does not mean that the subsidiaries are also Indian entities. First guideline, just because, okay, poem is dependent on place where income accrues, assets are located, employees render service, payroll cost, and place where board of directors meetings are conducted. These are all the parameters for determining poem. Subsidiary, for all practical purposes, is a distinct entity. Subsidiary is always a distinct entity. If the above said poem criteria are not fulfilled, then such subsidiary will only be treated as non-resident entity. Just because the poem of the holding company is in India, don't assume the other things. It depends upon, for each subsidiary, I will measure this. A foreign company appoints liaison office in India for spreading the name or products of the company. The liaison office just makes day-to-day and operational functions. Comment on poem applicability. Operational decisions are not considered as a criteria for determining poem, place of effective management. Operational decisions are not considered or never a criteria for saying whether the poem is in India or not. Okay? Only strategic decisions and other factors which you know I have written here, okay, will be considered. Hence, having a liaison office does not mean poem is in India. John Butler Tex Incorporation, company incorporated in Colombo, Sri Lanka. 60% of the shares are held by an Indian company. John Butler Tex Incorporation has its presence in India also. The data relating to are fixed assets in India, in Sri Lanka, tangible assets in India, in Sri Lanka, other assets in India, Sri Lanka, income in India, Sri Lanka, income from investment in India, Sri Lanka, number of employees in India, Sri Lanka. For poem purposes state whether the company shall be said to be in active business outside India. 2. Because of the increased operations in India, more manpower is needed. 30 more employees may be required in this regard. The company can either take these employees directly in its role or can outsource the increased operation to an external agency which will engage the 15 employees in the role and finish the work for the company. Which choice is better? Read through. Total income is 15, 42, 30, 13. 15, 42, 30, 13. Okay, 15 plus 42 plus 30 plus 13. Passive income, which is both are associated entities or plus other incomes. So in this case, passive income is these two only. Others are not given as associated. Others are not given as associated. So this only is passive. The total passive income does not exceed 50%. Hence, ABOI, active business is outside India. Poem, not satisfied. Active business is only outside India because more than 50% is not in India. On the basis of assets. Total assets 90, 40, 30, 70, 180, 90. Okay, 90 plus 40 plus 30 plus 70, 180, 90. 70 plus 180 plus 90. Assets in India 90 plus 40 plus 30. More than 50% of assets are located outside India. Poem not satisfied. Forty 60. 40 60. So more than 50% of employees are outside India, then two poem guidelines are not satisfied. So the companies, hence, in all criteria, the company's active business is outside. Then there is a part B to the question. Yeah. Yes. Then there is a part B to the question. Because of increased operation, more manpower is needed. 30 more employees may be required in this regard. The company may either take this employee directly in their roles or can outsource the increased operation to an external agency which will engage 15 employees in its role and finish the work. Which choice is better? The term employees means both direct and indirect. Even if employees are through contractual basis, it will still be considered as Indian employees. However, if it is outsourced to some other entity not related, then they will not be included. Okay. Where 30 employees are directly appointed, what happens? You can see here, this will become 40 plus 30 plus 60. 40 plus 30 plus 60, 130. Number of employees in India will become 40 plus 30, 70. 40 plus 30 will become 70. Hence, 50% or more of employees is in India. Hence, OM gets satisfied and the Colombo company will become an Indian resident. What is the problem now? Because 50% or more of the employees is in India, that Colombo company becomes an Indian entity. So that is the problem. Instead, if 15 employees are engaged with another company, even on contract basis, okay? Even on contract basis, what happens? 40 plus 15 plus 60. So what happens? 40 plus 15 plus 60, 115. Okay, number of employees in India will be 40 plus 15. Okay, 40 plus 15, 55. As a percentage, it will be 55 divided by 115 as a percentage, only 48%. Okay, more than 50, okay, so it will not be satisfied. Okay, okay, more, okay, hence contracting or outsourcing can be preferred. So you know why so many companies outsource, or what is their dimension of outsourcing? It all depends upon this. Oh, okay. I'll make the change. Thank you, Ajay Suresh. does not exceeds. Okay, very popular question nowadays. This very popular question. Okay, last three attempts except the August, other attempts. This is the questions that are getting repeated. Okay, ABC Limited, a software giant in India, set up 100% subsidiary in the name of SD Incorporation in Switzerland. The subsidiary company is mainly engaged in software service, hardware service, and data backup in three different countries: Switzerland, Sweden, and India. Following value of asset 24 plus 12, 36 plus 24. Okay, 40, 60. Okay, India 24, no problem. Number of employees 30 plus 10, 40 plus 28, 68, no problem. Payroll expenditure 4 plus 2.6 plus 5.4, so 6.6, 11, 12, up to no problem. Everything less than 50%. Everything in India is less than 50% so far. Everything in India is less than 50%. 24 out of 60. So these two, if you add it, it is more than this. That itself is a proof. Okay. Total income 80 crores. 28 crores which are purchased, made from associated, sold to non-associated, no problem. 24, both purchase and sales are from associate, I should take. 16, I will not take because sold, no, purchased from non-associate. 8 crore capital gain, 4 crore interest. So 24 plus 8, 32 plus 4, 36. So far, no problem. So far, out of 80, 36. During the financial year 2020, out of the 5 meetings, 2 in India, no problem, ABOI. Active business is outside India. Okay. Should be 75 or something like that. Total income 80, out of which 36. Okay, total income 80, out of which 36, only 45%. Okay, total assets 60, 24 in India, only 40%. Total number of employees only in India to the extent of 41%. Total payroll cost also 45%. Since all the above 4 conditions cumulatively has passed, active business is outside India. Poem of a company engaged shall be presumed to be outside of the majority of the board of directors meeting is also held outside India. 3 out of the 5 held outside India. Okay, same type of question only. That's why I am not taking and reworking. Okay, you can understand, but this is directly from suggested answer. Look how elaborately they answer. How elaborately, though you will take only 2 minutes. Okay, the problem is state the obvious. Write everything is the examination aspect. Okay, okay, right. So, the last part of the discussion for today, and so far not tested, we don't know when they will test. This year, a company's poem gets satisfied. So far, that company's active businesses outside India from this year or during this year, the company's active business becomes India because of asset test, employee test, payroll test, income tax, board of directors test, something they become an Indian company, resident Indian. What is the broader criteria for ROR? Global income is taxable. Wherever you earn, however you earn, it becomes taxable in India. So is for a resident company. Sir, so far I am a non-resident, sir. So far I am a active business outside India. Because of POEM guidelines getting satisfied, I become an Indian company. How the transition is going to happen is said in section 115H. How the transition is going to happen because POEM guidelines are fulfilled is said in 115JH. Transition provision. This section is applicable to a foreign company which becomes a resident company due to POEM guidelines. And this is only for the first year of operation. Sir, income and all okay. What will be the opening WDV? What will be the opening WDV? Simple answer. Take that company's tax record, whatever that company's opening WDV, take it our opening WDV. Over. Fine, sir. But in our country, there is no income tax. Take your books of accounts. Whatever is your opening WDV there, take it there. Thank you, sir. But in our country, depreciation is not mandatory. When did the asset get purchased? From there, I will try to compute. What will be the WDV of the asset? Where depreciation needs to be charged on asset according to the country in which the company is incorporated, WDV as per tax records. Simple. Where in that country depreciation is not mandatory, WDV of the asset have depreciation being charged from first year. Depreciation I have not computed. Compute according to that. If the books or records need not be maintained in such foreign country. Book value. Simple. Sir, what about the treatment of business loss and unabsorbed depreciation? Same, sir. Whatever is your tax record, whatever loss you have, bring it. Sir, we don't have tax at all, sir. Whatever is the books. How will the brought forward business loss and unabsorbed depreciation be treated? Whatever is the prevailing in the tax records of that country, bring it forward and adjust it over the remaining period. Our law says 8 years. So 3 years has lapsed, remaining 5 years. Where they don't have tax law, loss as per books of account. Sir, in our country we follow calendar year, sir. No problem, sir. First year take 15 months. And from there on follow 12 months. Sir, we don't follow calendar year. We follow June to July. In the financial year 2021, the foreign company becomes an Indian company due to POEM. The foreign company is following calendar year. According to this section, this needs to be converted for the financial year 1920, 15 months. Because for us 2021. So Jan 19 to March 20. In the financial year 2021, the foreign company becomes due to POEM. The foreign company is following July to June. Take July to March. That is, up to 15 months follow it. Otherwise, whatever from your year date to immediate March 31st, you bring it. If it is up to 15 months, or even they are saying less than 6 months in a calendar year. Okay, don't worry about that. First year, 15 months, okay. Beyond that, let them start on any day and end it on 31st March. The foreign company needs to comply with the resident entity only from the date it is declared as a resident entity. So no prospective application, only retrospective application of provision 115JH is a transition provision which is not so far questioned. But while doing this material, I thought I can include a question and try to understand it from the practical perspective. The answer is not there. Now you will have the answer. Transglobal Incorporation, a company incorporated as per the laws of Ireland, became a resident company during the previous year due to FOIM guideline. On evaluation of books of accounts of such company, you can't understand the following position. Building purchased in April 17, 45 lakhs in INR. Computers 1770. Other assets 710. The book value of the assets on 1st April 2020 are 40, 14 and 5. The depreciation are 10, 20 and 30 under the tax law of the respective country. However, depreciation is not mandatory charge in such countries. This apart, the company has accumulated loss of 21 lakhs which is carried forward from the past years. From the facts provided, answer the following. Determine opening WDV of the foreign company. Okay, transition mechanism. Determine the opening WDV. Okay, where depreciation needs to be charged, WDV as per tax account. Where depreciation is not mandatory in that country, okay, I will recompute the depreciation. Determine the opening however, depreciation is not a mandatory charge in that country. However, depreciation is not a mandatory thing, okay? Where depreciation is not mandatory in the other country, we need to compute the opening WDV by charging depreciation at the rates prevailing in Indian law from the date of acquisition. So, building, computers, other assets, 10%, %40. Let's take it as 10%. I should have given you what is that other asset. I meant furniture, but I have not given you. Okay, please consider 45, 1770 and 7,10,000. First year, okay. Building is 1st April 17. $45 lakhs. Depreciation for 1718. Depreciation for 1819. depreciation for 1920. Okay, WDV as on 31/3/20 or opening WDV as on 1/4/20. This is the value I want. Where depreciation is not mandatory, I will take the depreciation as per Indian law. As per Indian law. Computer is purchased on 1/4/18 for 1770 and furniture, take it as furniture, okay, 7,10,000. So where depreciation is not mandatory. Had depreciation been mandatory, I would have taken the same values. Depreciation was not mandatory, so I reworked the values. Quickly. What will be the opening WD if the company is not assessed to tax in Ireland? Where the company is not assessed to tax, then book values will be considered, which are nothing but 40, 14 and 5. 40 lakhs, 14 lakhs, 5 lakhs. You can see how much of a difference it will make. Okay, book values will be considered if nothing, if they don't have the tax values. How will you deal with the brought forward loss? This upon accumulated loss 21 lakhs, which is carried forward for past 3 years. Okay, brought forward loss slash unabsorbed depreciation shall be carried forward and adjusted over the remaining period. Over the remaining period. Okay. In the given case, 3 years of loss has already lapsed. So it will be carried forward for 5 years and adjusted in the maximum period of 5 years. Is the company eligible to claim foreign tax credit, if any, in the financial year 2021? I leave this question open. Let me come back to foreign tax credit because last paper itself in August, I'll show you the paper also. People were fumbling, what is this foreign tax credit? Allow me to explain you foreign tax credit. Okay, right? A company which has fulfilled POEM guidelines can take foreign tax credit because it becomes a resident entity and taxes payable in India. If the taxes, if that income is included, tax can also be allowed, provided agreement exists, etc. foreign tax credit. When I do DTAA, I will explain it. Probably I'll remember to come back and write the answer here also. So very rarity, I have not seen a question so far on poem guidelines, but on transition provision. Poem guidelines is a regular question. Transition is a rare question. So in we have just started breathing into it. Okay, the non-resident taxation. We have completed residential status along with the transition mechanism for company. Scope of total income is the fulcrum of entire non-resident taxation. Scope of total income, what is taxable in India, under each head how it is going to be taxable. Along with the exemption provision, we will start traveling from 9 a.m. tomorrow morning. 9 a.m. we are going to start with scope of total income.